Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking with Seth Masters. Seth's career is enviable by most people in the financial services industry. He began his career at Booz Allen, consulting to large corporations. After that, he spent 26 years at AllianceBernstein in CIO roles for the DC business and the Bernstein Private Wealth Group. Since then, he has been an angel investor, which is the focus of our conversation today. So Seth, thank you for being here.
My pleasure.
First, could you give us your overall view of the early stage market amid all of the uncertainties that there are in the market right now?
Well, obviously, in the near term, there is a lot of uncertainty in the early stage market for the same reason that there's uncertainty everywhere else in the capital markets. And obviously, right now, the terms on which people can raise money are becoming a little bit less attractive to the founders, and that's also normal. But in fact, I'd say the conditions right now are in some ways almost ideal. And that's not just a function of being in 2023 with all the things we know about the world today. If you go back and look historically, it's quite striking how the best vintages of startup companies almost always happen during fairly challenging economic times. So the cohort of companies that came out around 2008, 2009, including companies like Uber, and the companies that came out in the early 2000s, which included this little company called Google, remember them?
Right, sure.
And then I can keep on going back, but it's been a recurring theme, and it's not an accident. It's because times when stress is high in the economy in general mean that two things are true. First of all, companies that are already big and established are under pressure and maybe a little bit more open to trying something new than they normally would be, which is especially helpful for B2B type startup companies. And the other thing is that those same companies that are the traditional enterprise ones that are shedding workers, which we're seeing happen today, are creating opportunities for startups to hire smart people with experience. So it's not totally crazy to think that this is probably, when people look back, going to end up being a very interesting time for investors in startups, both because the likelihood of some big winners being out there is a bit higher than normal, and the deal terms are probably becoming more attractive on average for people who are investing.
Do you think that the stresses put the importance of due diligence and good underwriting into a stronger place also, or do you think that's sort of stable across time?
Totally stable across time. I think that there's never been a moment in time when it wasn't absolutely critical to do due diligence.
When you look at all of this opportunity that you see, or these relatively small but very, very present opportunities, how do you place that in your overall asset allocation?
Well, first thing to point out is that it is a really important issue to get the asset allocation right for any type of investor.
Right.
And it's also important to try to figure out how to do that in some kind of systematic way. And usually the way people do it is to try to figure out how much return are you getting for how much risk in a given asset class, and also what kind of correlation does it typically have with the rest of my portfolio. And if you look at those indicators, the return profile from early stage investments at this point is pretty clearly one of the most attractive sources of return that have ever been seen. And that's partly because it's been, the last 40 or 50 years have actually been a time of fairly significant technological and social change, and startups have been a huge part of that. In fact, many of the startups from 20 or 30 years ago are now major parts of the S&P 500.
Right.
So that's an amazing story. So that sounds like it's a good thing. It's also really obvious that the correlation between the kinds of investments you make in the early stage and most stocks, and definitely versus bonds, are very, very diversifying.
Right.
The problems, though, are that there's two things about this asset class, the early stage investment world in general, that are really tough to pin down. The first is it's really, really risky, but it's hard to even know how to dimension the risk in the way you think about when you're thinking asset allocation.
Mm-hmm.
So remember, I grew up in the liquid world,
Right.
where you could buy and sell a stock. You can also buy and sell a bond. It's not quite as easy, but it's pretty much like that. And there's a whole variety of other things like that, commodities and
swaps and
and all kinds of derivatives, where literally if you want exposure and you want to tweak it, you can do it 10 times a day, 10 times a minute.
Mm-hmm. Yep.
Well, when you're in early stage land, you can maybe do it at some points of time when the company and you both agree on terms.
Right.
But it's basically like buying or selling a house.
Right.
It's
right.
not an easy transaction. It requires a lot of time and effort and paperwork to make anything happen.
Mm-hmm.
And you don't know when you do a transaction exactly what's going to be the next opportunity to either buy more or sell some. You have no idea. So how exactly do you think about the riskiness of that? The one thing we do know about the riskiness of that is that of all of the startups that have been tracked by most people in the business, the failure rate, which really means it doesn't mean the company actually goes bankrupt. It means the company doesn't end up paying anything at all to its investors.
Right.
Maybe it's a successful kind of lifestyle business, but
right, it's a default risk.
But as the investor, you get zero,
mm-hmm.
and that means you've lost 100% of whatever you put into the company.
Mm-hmm.
And worse yet, in that case, you don't even get a tax deduction for having lost all your money. So over 70% of all startups end up as a zero, a big goose egg, for whoever invested in them.
Right.
Think about that for a second. And think about the fact that despite that, the overall record of return is very attractive. And that's because when you do get a winner, it can be a very big winner.
Right.
And that's something that's tough for most traditional asset allocation frameworks to capture.
Mm-hmm.
And the other thing that's pretty tough is the that combination of that plus liquidity, which makes managing this a bit tricky too. First of all, there's the big J-curve effect, and J-curves are especially, they are steeper as you get earlier in the process.
Right.
So it's the biggest, most scary J-curve you've ever experienced.
Right.
And the second part of that is that you also, if you're really being religious about your asset allocation, your likelihood of getting whipsawn, if that's a word, is really high too.
Mm-hmm. Just
think about what happened in 2021 and 2022. And I also sit on boards of investment committees and things like that, where you have to make asset allocation decisions. And I know that what was going on throughout the investment world was in 2021, when stocks and bonds were both on a tear upward.
Right.
Everybody who had a program to invest in venture was trying to put more money into venture because they were below their targets.
Mm-hmm.
So they made big commitments in 2021, but then they started funding in 2022, and then all of a sudden, both their stock and bond portfolio were going downhill fast, but the marks on private equity in general and venture in particular were, in fact, still going up because of the lag time. So all of a sudden, it looked like they had gone from being way underweight to way overweight in a heartbeat.
Right.
So with all that said, how do you actually make these decisions? I think the answer is going to be incredibly specific to who you are and what your governance process is.
Okay.
And I think in practice, what I'd say is that this is an asset class which is most appropriate for large family offices, for large endowments and foundations, basically entities that have a very, very long horizon and who have a tremendous ability to essentially deal with all of these risks and these issues. And then there's one other reason why that's so important, because the way you really end up doing well in this space, whether you're investing directly like an angel does, or whether you're investing through venture funds or some other kind of provider of access to the early stage space, the way you win is not just by making one investment, but by making follow-ons.
Right.
And so you have to have that long-term type of commitment and really not be too terribly worried about the exact asset allocation that you're at now, but rather think of the asset allocation that you're making to this as a very long-term thing, which is constrained by more your liquidity risk exposure, not your investment risk exposure.
Right. And I've often wondered about this, and I wonder what you think also, that this is exceptionally germane to how wealthy families who founded those family offices made their money in the first place, by ratcheting up risk, by concentrating, by doing all the things and being able to stand with that risk for a very long time until their liquidity event. So it seems quite close to home for a lot of family offices that were maybe founded by someone who founded a company and took it public or sold it to a competitor.
You know, that's a great point, which has another corollary to it. And that is that when you're looking at family offices, and the family office is currently serving the first generation or G1, it's often almost obvious for them that they should be doing early stage type investing. And then G2 will probably also have a bit of that feel. But by the time you get to like G4 or G5, it actually may not be relevant or attractive anymore, because at that point, first of all, the number of members of the family
is enormous.
Yeah. And their needs vary greatly. So you may not have the same ability to manage liquidity that you had in the earlier generation. So I think the framing that you just brought to it is a really, really good point. Just because some family offices can and should do this doesn't mean that all of them can.
Right. I also think that it is exceptionally difficult for even the wealthiest families to stay wealthy through 4 generations.
That is true.
There are so many things that happen, but I digress. A question that's connected to the asset allocation question is, how do you think due diligence on this sector differs from the more traditional ones we've talked about?
Yeah, so another aspect of early stage investing that's super important to understand is that, yes, the asset class as a whole has very attractive returns historically, as far as we can measure them. And obviously there are some asterisks or issues with any measurement of any asset class. But in the case, the survivorship bias problem is a very big problem in the early stage space. However, it's pretty clear that you can get a very attractive IRR or whatever other measure you're looking to achieve over the long run if you have alpha.
Right.
The whole concept of beta doesn't really work in the early stage space. Having alpha means you have to have some kind of systematic edge, some source of return. And it's pretty darn clear that there's a very small number of ways you can achieve that.
Okay.
But there are at least 2 that I believe are well substantiated in all of the evidence that I've seen. One way you can do it is by having essentially a strategy that looks for those rare winners and tries to have essentially a much, much higher home run hitting success rate than the average. And obviously in this case, it's not just, a home run is worth, one run plus however many people were on base, which is a whole lot better than what most innings deliver.
Right.
It's potentially 10 or 20 or 30 times better than that, if you're very fortunate. So the power law rule that's applying in early stage space is a really attractive thing to have in your back pocket if you can actually materially increase the number of winners you get. And in fact, there are some VCs that I think have demonstrated that they've been able to do that over long periods of time. And their methodology is pretty clear. Right. First of all, they have huge portfolios with literally hundreds and hundreds of companies. And that's because when there's a power law kind of situation, the law of large numbers is definitely something you need.
Right.
You cannot just have 20 positions in a portfolio and hope that one of them is going to be the 1 in 100 big winner, because that means that basically the majority of your funds are going to fail and then your reputation goes down the drain.
Right, or 70% of them will.
Right. So, and the IRR won't be good. So you can't, that's way too much operating risk for. So they have hundreds and hundreds of companies, and they have an ecosystem that they build to nurture the companies that they invest in and give them unfair advantages.
Right.
Most of these companies are on the West Coast.
Yeah.
Not all, but that is the culture there.
Mm-hmm.
And there's no question that works. But it doesn't work for me as an angel investor.
Right.
I'm not going to have hundreds and hundreds of companies in my portfolio.
Right.
That doesn't make sense. And luckily, there is another strategy that's actually, in my mind, as good. It's just different. And that is to try to reduce the number of losers.
Okay.
And of course, the West Coast guys do due diligence too. But if your goal is to reduce the number of companies that end up being total duds,
Mm-hmm.
at least from an investor's standpoint, they might be wonderful companies that provide a service that just doesn't make enough money and doesn't grow fast enough to be worth, an exit. But,
right. Sure.
But if you see that that's what's going on, by all means, help the entrepreneur if you want to do that just because you like them, but don't invest money in them,
mm-hmm.
because the money isn't going to be a good return for you, and ultimately it's not, that's not how you win. And by the way, there are also plenty of companies that have great ideas that just don't have a good fit with the market, or where the timing is wrong.
Right. That's the big one, right? Too early, too late.
And the founding team are just not the right people to make it happen.
Right.
Or 20 other things I could tell you that have,
right.
In many cases, personally affected me when I didn't do the due diligence, or didn't do enough of it, or get it right.
Yeah.
So yes, all of those things are the things that you have to be constantly looking for. And if you are reasonably good at that, and you can get the failure rate from 70% down to something if you could get it from 70% down to 50%,
right,
the leverage that has on the kind of returns you can expect from your portfolio are immense.
Right. Or it effectively means your portfolio can be smaller in terms of names.
Yes. So the number of names still has to be bigger than most people would think.
Uh-huh.
I've done a fair amount of modeling of that too, and it looks to me like you really need to have, for a mature portfolio, at least somewhere in the high 30s to maybe mid 40s is probably the sweet spot where it starts where at the margin your incremental expected return per unit of risk begins to really flatten out.
Okay.
But I would say this for anybody, which is if you're gonna make less than 20 investments, don't bother.
Oh, okay.
But one thing that is interesting and totally blew me away, and I didn't expect it, is that doesn't mean you have to invest in 40 or 50 different companies. It means you have to invest in that many different rounds.
Right.
And
right.
Here's something that is really weird, but it's actually quite helpful, which is, yes, it's true that if you make multiple investments in the same company, there is one thing that they all have in common, which is the exit will be the exit for all those rounds.
Right, whatever it is, yeah.
But the risk and return characteristics of each individual round are surprisingly uncorrelated to each other.
Okay.
It's a longer story than we probably have time to deal with here, but what it means is you can get a fairly significant amount of diversification from having a portfolio of maybe 20 companies, but which collectively involve 40 or 45 different rounds because you had multiple investments, as some of the ones that were doing well went through their life cycle and needed more money.
I never would have guessed that.
Yeah, me either, actually.
That's
what's fun about going from the liquid world to the early stage and very illiquid world is so many things just are different,
right,
for reasons that you would never, ever have anticipated. And that makes it very challenging, but also very fun.
Yeah, it's a little confounding to the belief system you've created. Yeah, so.
Well, listen, literally, I have had exits where some of the rounds that I thought would be worst ended up being a pretty attractive return, and some of the rounds that were the earliest rounds ended up being least attractive, even though the entry price was lowest.
Right, right.
So it's a very interesting thing.
Well, I think we've demonstrated your skill, your intellectual curiosity about this sector enough that this is the right time to ask you this question, because I thought this was exceptionally fun. When we discussed this before the podcast, you told me that you declined to become the GP of a VC firm. That's a job that a lot of people who are listening to this podcast would kill for. So how did you decide to decline a job that so many people would love?
Well, I think that the most important thing for anybody as they move through their life is to decide really what's going to work for them and bring them, joy and hopefully success, but most importantly, really challenge them in ways that they want to be challenged.
Mm-hmm.
And I'd spent 27 years at Bernstein and then AllianceBernstein, and I'd been in the position of being a fiduciary and managing money for people, and I understood how that worked in general in the early stage world. And I think that a lot of VCs are really providing a key need and have resources that obviously you don't if you're an angel.
Mm-hmm.
But what I also felt was it was really different if you actually were investing your own money.
Yes.
You did not have to deal with LPs.
Right.
And you were in a position where you really could do anything you wanted.
Mm-hmm.
And I'd never had that freedom before. So
Right.
I thought, well, I really want to see what that's like. And I'm actually very happy that I did that, because I'm still part of an ecosystem where VCs are very important, and I want to, often have them in get into deals that might be a win-win for them and me, right?
Yep,
That's
yep,
part
sure.
of the game.
Yeah.
But I think I can do that now in a way that I wouldn't have been able to do otherwise, because angels just don't have the same exact set of constraints and potential conflicts of interest that is inevitable when you're a GP and you have to deal with the problems that you have to deal with as a fiduciary.
For sure. Before we go, I did want to bring this back to a higher level, because something you mentioned earlier is something that I think we have not seen very often, and is also confounding to asset allocation models all around the world. And that is that the risk that the correlation, that inflation will raise the correlation between stocks and bonds. And how do you think the investment managers who are listening to this podcast should address that risk for their clients?
Well, first of all, I think it's absolutely, the short answer is yes, that is very likely to be the case for some reasons that are pretty obvious, which is when inflation is rising, that's causing the kind of behavior we're seeing now to happen, which is interest rates tend to rise. That's bad for the bond price, but it's also bad for the stock price, because you're discounting the future at that higher rate.
Right.
And there's a number of other reasons too why the correlation tends to rise when inflation is higher.
Mm-hmm.
But I think that there's a more nuanced story here too, which is not told as often, and that is that the uncertainty about inflation is probably even more responsible for an increase in the correlation between stocks and bonds. And that's because the more uncertain you are about inflation, the bigger the risk premium will be, by definition.
Right.
And that crushes both.
Yes.
And so because it's crushing both, it also increases the correlation.
Okay.
And that's one of the reasons why inflation cycles tend to last longer than you think, especially if the underlying sources of the problem are hard to predict. And so on this front, I think it's worth just saying, I have no insight specifically, that I know what's going to happen on the inflation front. Who knows?
Fed policy,
But
I know.
I would just be very cautious about believing that anybody else has a lot of information about this, and that if you look again at the pattern of history, just as I was talking before, you can make some statements about early stage investing. You can make some statements about inflation too, because it's interesting to see. Inflation cycles are relatively infrequent things.
Mm-hmm.
They tend to occur roughly once a generation.
Yeah.
Just fairly long cycles.
Right.
Personally, I think it's possible that one of the reasons for that is that it takes about a generation to forget how terrible the last inflation cycle was.
Right.
And then people, when they forget, start to make the same mistakes, and then we get another inflation cycle.
Uh-huh.
But in any case, for whatever reason that is, I think what we do know is that a lot of the focus on so far in this cycle has been on specific causes of inflation that might perhaps be more temporary.
I mean, the housing market and wages.
Housing market, also supply chain issues, and COVID, and. There have been all these things that are clearly relevant. Oh, and the war in Ukraine most recently.
Yeah.
But in fact, my view is that you the thing that is the real risk here is the possibility that there's an extended period with a higher correlation between stocks and bonds and uncertain inflation that keeps it that way for a while.
Right.
Again, I don't know anything about this actually being the case, but it just occurs to me that it's interesting to look at how we got into the position that we're at now. We were in a very extended period of strikingly low inflation when it was hard to understand why everything wasn't becoming more inflated when you had all these things like deficit spending that you'd normally expect would lead to inflation. Why was that? Well, I think we know. That was a period when over literally 35 years, there was a strong disinflationary pressure because mostly China, but some other countries too, were globalizing themselves and all of us to a degree that was really, really unprecedented.
Which was pushing the cost of goods
down.
That
was pushing the cost of goods down and also the cost of capital down.
Right, okay.
And I don't know that this is going to be true, but there certainly are a lot of signs on the horizon that would suggest that over the next, not just year or two, but probably 5 or 10 and maybe more, we will be seeing an extended period where that is undone, where we get into a deglobalization mode, which would be inherently a cause of sustained inflationary pressure as all of this very complex but incredibly, quote, economically efficient, use of, Adam Smith's wonderful insight that it is really true that the broader your scale, the more efficiency you can have.
Right.
But on the other hand, some periods of time, people decide that efficiency isn't as important as something else.
Yeah.
And in this case, it's obviously going to be about, security and who knows what else. But if that turns out to be a very long-term phenomenon, if we do go through decades of deglobalization, I think that unfortunately that will come with steady inflation pressure for a while that will be hard to manage.
Yeah, I think I probably share this view with a lot of people who are listening to this podcast because the time I came up in, globalization seemed to be the thing that was going to have peace dividend. It was going to have the efficiency. It was going to match buyers to sellers. It was going to do all these great things. And there's a part of me that wonders, am I resisting the idea of reshoring now because I taught to think that way, or because I actually think it's a terrible idea? It's fascinating. Well, Seth, this has been great. Thank you so much for being here.
My pleasure.
And thank you all for listening in to this podcast by CFA Society New York, Compound Insights. Until next time, I'm your host, Rob Rowan.